All right, so chapter 5. What the heck? It's 11. Hmm, Hold on, what's going on here? That's why. Okay, sorry. The keyboard was just off. Okay, um, so chapter 5. We're going to be talking about this other type of business uh, which sells goods. Okay, so you can say there's two major categories of businesses: service providers and those businesses that deal in goods. Okay, so one of them is a manufacturer, which we're basically gonna be covering in the next class, 187. Okay, we're not really gonna talk about the accounting for manufacturers too much here because it's a little involved. This type of business deals also in goods, but they're not making them. They're just selling them to consumers or to other businesses. Okay, so this is what we call merchandising business. So we're going to describe the business model. So we're going to talk about, what a uh, what a merchandiser does. Okay, and it's multiple. It's not just one type of merchandiser. Okay, so we're going to talk about kind of the two major class of business models for merchandiser. Um, there are new additional accounting issues that are going to be involved with a merchandising business. Okay, so we're going to have to deal with inventory essentially. Okay, so we're going to talk about when inventory is purchased. Okay, there's a set of uh, kind of accounting treatments for when you are in a merchandising business and you're buying inventory. And then there's a separate set of transactions in accounting when you're selling those items to your customer. Okay, so the interesting thing about a merchandising business is that they're both customers and they're providing the goods for their customers. Okay, so we'll have to differentiate because the accounting is a little different when the business is the customer versus when it's the seller. Okay, so we'll talk about the different kind of situations there. There's some adjusting entry kind of specific things for merchandising businesses, and it's really just because we have new accounts that are involved. Okay, so we'll talk about what some of the adjusting entries are for this new kind of situation that we're encountering. Um, we'll talk about how merchandisers typically lay out their financial statements, and particularly the income statement. I think we've touched on this a little bit. We looked at Costco, um, but we'll just revisit that to make sure we're clear about that. And then we'll talk about the financial ratio, the gross profit, um, because really the key kind of business model for merchandisers is this: buy low, sell high. That's what they're doing. Okay, so you want to see how well you're doing that. Okay, so the basic business model. Okay, this is uh, the first one here is kind of what we call like just I guess it's the general it's like the general idea of what happened of what it's doing. Okay, so what is happening is that this is your business. This is the merchandising business. It's buying inventory from some vendor. Okay, so uh, this vendor could be, we're going to see this kind of in the bottom here, but it's basically someone who's providing you with the inventory. Okay, so uh, if you're a large enough retailer, okay, uh, you're buying from the manufacturer directly. If you're like a little convenience store, you're going to be buying from a wholesaler. Okay, and we'll talk about why that is in a second. But basically, you have someone providing you with the inventory, who is your vendor. That's kind of the term for that. The inventory is going from the vendor to you. You're holding it as inventory. Okay, so on your balance sheet, this inventory, you're paying money for it, but it's not an expense yet. Okay, It's still it's going to be an asset on your balance sheet. Okay. Now that inventory at some point, you hope, is going to get sold. Okay. So this inventory now is going to move to this buyer. Okay. And at this time, whatever you paid for this inventory, it's going to come out as an expense. Okay. So let's just do a very simple example. If we bought the widget for $1 and we sold it for $2, right? At least we can see we made a profit. We agree? Okay. So in this example, the revenue, this $2 is the revenue, right? We're going to call that sales revenue. But we need to match it against the cost of the inventory because this is not a pure profit, right? We had to buy that inventory in the first place. So at this time, this asset is going to be expensed, okay? And we're going to call it cost of goods sold. This is an expense account. So just like we had like prepaid insurance, right? It was an asset. Then it came out as what? How did we expense prepaid insurance? I know you know, but does someone else want to help me? Yeah. Insurance expense, right? So that asset, prepaid insurance, went down and it came out in the income statement as an expense called insurance expense. So it's the same thing here. We're going to have inventory on the balance sheet. At the time that that inventory is sold, it's going to get expensed as cost of goods sold. So our inventory balance will go down. We no longer have that item. And the income statement is going to have both this revenue and this cost of goods sold in the same place. Okay. So people, I think, just remember this. Say it with me even. Cost of goods sold is an expense. Say it. Okay. So is that a debit or a credit normal? Debit, right? Because all expenses are debit normal. Okay. So the wording of it, cost of goods sold, it's not obvious that it's an expense, but I'm hoping now that you said it, it's like somewhere lodged in your brain that it's an expense because I think a lot of students like are kind of like confused about that. Yeah, Chris.
So since there's at least two accounts for every transaction, when you first acquire the inventory, what is the other?
Okay, so look, every sales transaction, we're going to get to this. Good question. Every sales transaction is going to have two journal entries. There's going to be one journal entry for the revenue, just to record that, and then another one to do this inventory to cost of goods sold. So there's going to be two separate journal entries for every one sales transaction. Okay, so
Well, what about when you first?
yeah, so there's one journal entry here where you're paying cash for inventory, right? But this sales transaction is going to be two journal entries. Okay, so that's what I'm saying. Like when you are the customer, when your merchandising business is the customer, there's certain accounting you do, and then when you're selling, there's a different set of like accounting considerations. Okay, but good question. Okay, so look, uh, this is kind of the full value chain of, you can say, uh, businesses that are involved in the selling of goods. Okay, so there's some manufacturer that's making the item. So they're going to manufacture it. This inventory is going to get sold, let's say in the kind of most typical case, to a wholesaler. Okay, because why can you, let's say you own a little 7-Eleven convenience store and you have candy bars. Why can you not just go to whatever, Hershey's Corporation, be like, hey, I want to order 100 candy bars for my store. Why can't you do that? Yes, it's not a big enough purchase, right? They're not going to deal with you because you're buying too small of a quantity. Okay, so this wholesaler is an aggregator. Okay, they're making a very large purchase, large enough that the manufacturer is going to kind of deal with them, and then they're going to kind of act as a middle. They're like kind of an aggregator for all the smaller people that can't directly buy from the manufacturer. Okay, you can think this role is actually really important in society. Okay, let's say there's some riverfront land. Okay, who can typically afford to do that? Who can buy that land usually? Like let's say there's this one house. Is it going to be expensive or cheap? If it's on like lakefront property, it's going to be expensive, right? So it's going to be not very accessible for most people, right? So there is a middle person called a developer who will be like, hey, actually, I think 50 people could buy 1/50th of this. So what I'm going to do is buy that land, build an apartment building or a condominium development, and those 50 people can then live on the lakefront, right? So this idea that smaller demand units can be aggregated by some middle person, it's actually a really important function in our economy. And there's a lot of businesses that do this type of thing. Okay, so in the case of uh, in the selling of goods, that's the role of the wholesaler. Okay, so the wholesaler will buy that inventory. They're going to then distribute it out to the retailer. Okay, so this is where us as consumers, that's where we interact. Okay, we're going to go to the store and buy stuff. Okay, so again, the inventory is bought from the wholesaler by the retailer, and then the inventory is then finally moved to the consumer. Okay, so at every point of this is, $1, it's sold for 2, and then they're going to sell it for 3, and then we buy it for 4. Okay, so at each point, there's going to be a little profit that's made. Okay, and maybe the manufacturer, it cost them 50 cents to make the thing. So this is kind of the value chain, as we call it. Okay, and each person is providing a service because not only does the wholesaler aggregate the demand, they're also providing a very important transportation logistics service, right? They're getting those inventory items to your store. They're gonna typically have some distribution method, okay, to distribute all the inventory to all these little places. Okay, so each of these requires like an incentive to do so, and this is the profit incentive, right? Um, so each of them is going to take a little profit along the way, but they are providing some value, right? They're providing some economically useful service. Okay, so but it is possible that some retailers, Costco, Walmart, Target, these are like really large retailers where we as consumers shop. They can also buy a ton of items, right? So they actually put out this and they just buy directly from the manufacturer. Okay, so that's why they can sell it for cheaper too, because they're kind of this profit that's taken at this step, they're cutting out. Okay, because they're buying enough quantity to get it at this $1 price instead of having to buy it for whatever, $3 from the wholesaler. Okay, makes sense? Yeah? Okay. Um, okay, so let's just make sure we're understanding. Let's do a little discussion here. Here's some questions. So the first one, think about some retailers that you interact with. So, think about we all know what these businesses are. So now just be clear in your head what that is. Think about if you know of a wholesaler. Okay, this is we don't, as consumers, uh, usually interact with wholesalers, but maybe you know. Okay, so discuss that, see if you can think of one. Um, if you are a retailer, what metrics do you care about? How do you know that your business is performing well? Okay, so think about that. And it's kind of related to this last one. Okay, so I'm giving you a very specific example. Your store has room for one banana at a time, and you're buying it for $1, okay, from your vendor. So, what are the different ways that what are the different kind of business models uh, can this retailer kind of enact to make a profit? And there's two of them, okay? There's two levers that they can pull to make a profit, or like two strategies, I guess you can say. So see if you can come up with those. So why don't we take a couple of minutes, you guys discuss amongst yourselves, and we'll discuss as a class. Okay, so what are some retailers? I heard the common ones: Walmart, Target, Best Buy. where you buy your groceries, so like Whole Foods or Trader Joe's. These are all examples of retail businesses. Okay, yeah, Home Depot. Okay, what about anyone know any wholesalers? Can anyone think of any? Yeah, yeah, because they distribute what? Food. Yeah, exactly. Yeah, or like Cisco, they're another food distributor. So yeah, but a lot of these are like behind the scenes. You see this term B to B. What does that stand for? What do the B's stand for? Yeah. Okay. What is the other business model? B to C, right? Business to consumer, right? So these are usually business to business. So unless you're like a retailer, you probably like, unless you have some retail, because I'm sure there's like large clothing distributors, like there's distributors for anything you can think of, electronics. Um, so yeah, but unless you're in that retail space, you're probably not going to know. Okay. Um, like construction supplies, there's like distributors, wholesalers for that. Um, Home Depot actually has a wing, HD Supply. That's like their wholesaler for construction related uh, goods. Okay. Um, okay. If you're a retailer, what metrics do you care about? What's the important thing? And let's just frame it with this banana. So if you're buying your inventory, your banana for $1, what do you care about? What's the most obvious one? Yeah, selling it for more than $1. So that's one of the levers. So your retail price. Okay, what's the other one? Any other ideas of how I can maximize my profit? Yeah. What do you think? Okay, yeah, that's if you can buy cheaper, but there's another one that's like a little more fundamental. It has to do with this idea you can only hold one banana in your inventory at a time. Yeah, exactly. Turnover. Okay, we call this inventory turnover. All retailers are limited in how much items they can store in inventory. So there are some, uh, let's say, luxury retailers that they're going to charge a higher price here, but they're going to sell less stuff. Okay, so they're trying to make higher gross margin. Okay, they're trying to buy at some price and sell at a price and make a big spread on that item, on that single item. There are some that are like velocity based suppliers or like velocity based retailers where they're going to buy low and sell high, but they're going to cut the price and just try to make the lower margin, but a bunch of times. Okay, they're going to try to if we priced our banana at $5, if we just sold one of them, we're going to make a huge profit, right? We bought for $1, we sold for 5. But how many people are going to buy a banana for $5? You're gonna have to like market it up and have like a really people will. If you go to West LA or something, there's probably like people that are throwing money away on food. But the other models, you sell it for $1.50, there's gonna be way more people that are gonna buy it, right? So you'll be able to make, even though you're only making 50 cents per sale, if you can sell 10 times as many bananas, you're gonna make more profit, right? So these are the two kind of levers that these businesses can pull to make a profit. And you'll see different retailers have some combination of these two. Okay. Okay. Any questions on this? Make sense? Okay. Good. Okay. So look, Costco is like one of the greatest retail stories of all time. This is like an amazing, amazing business. So let's talk about some of the numbers. So they generate 275 billion in revenue per year. Okay. That's the retail price, basically how much we all go in the store, buy stuff. If you aggregated all that, it's going to be 275 billion per year. At least this is in 2025. This means that for every square foot of space in that store, it's $1,800 of revenue per square foot. Okay, so if you took all the Costco stores, saw how much floor space there is, divided by the revenue, it's quite a lot, $1,800 per square foot. Okay, if you compare this, just to give you a comparison, Walmart and Target are 400 to 600 a foot, and the higher this number, it's kind of like, it has to do with this velocity thing I'm talking about. You can see that this luxury retailer, Tiffany, is higher, but they're selling jewelry, right? So you would expect that that store is going to generate, it's a small store, smaller footprint, but they're selling really high priced items. So this is not surprising that per square foot, they're making $3,000 a foot, okay? Because they're selling really high priced items that don't need a lot of space to store, okay? Lululemon is selling like high end apparel, right? They also have really small stores that sell expensive stuff. So the fact that Costco is selling kind of like everyday food items and stuff, and they're generating the same revenue per square foot or more than Lululemon is pretty amazing. Okay, it's an extremely productive use of retail space. Um, they also, another way to look at this is per Costco employee, there's $750,000 of revenue. So each person working at Costco, they're they're contributing $750,000 of revenue to that business. And of course, this doesn't include all the overhead, and each employee has a salary. So it's not just like pure profit, but that's very productive. Each person that they have there is contributing a lot to the business, okay, on average. Yeah.
Costco buys items, so revenue does not represent what
The profit. Yeah, of course not. Okay, so this is the next point. So Costco, they have a company-wide policy where their gross margin is limited to 15%. So if they bought something for $1, the most they're going to sell it for is $1.15. Okay, this is for Kirkland items, and the highest they're going to sell for non-Kirkland items is $1.14. They're never going to charge a gross margin more than that. Now, they could increase their margins, like just by raising some stuff by like 50 cents, it's going to increase the margin by a lot. Okay. Why do you think they keep this as a policy? What benefit does that have to their business?
speed of, like, again, inventory turn on.
Yes, that's true. But you could argue that the consumer is not sensitive to like a 15 or 20 or 50-cent increase in the price. There's another subtle reason. Yeah, loyalty. If you as a customer know that the price you're getting in Costco is the lowest, you're never going to go anywhere else. Okay, you're not going to price shop, you're not going to whatever. You're going to just go there to buy all your stuff. And so they're trying to capture all the spend from their customers. So that loyalty that they get from making sure that they're not skimming their customer, the customers kind of know this. They know that they're not going to get their stuff cheaper from anywhere else. And so they're just going to go to Costco and shop. Okay. So it's a very intentional policy that they have. Okay. This is a key, like, kind of accounting business model thing that I think people don't really understand, or like the common person doesn't know about. But now you guys are all, financial analysts, accountants in the making. So I think it's kind of cool and actually quite amazing. Okay, so uh, the Costco model is that they're just gonna buy stuff in bulk and they just kind of dump it on the floor. Okay, there's no nice displays, and it's not a very like aesthetic place. Like if you go to like Lululemon, they got like probably injecting all the stuff in the air to make it smell good, and they're trying to get you in the buying mood in a much more like salesy way at these high end retailers. Costco just puts the stuff out there, has a price, and you just like go in there and shop, and you actually just take it off the pallet. They're not even like putting it on shelves in a very like fancy way, right? They're just kind of putting stuff out there, and you just go and buy it. Okay, so it's very easy for them to do that. You don't need a bunch of people to stock the shelves. Like if you guys have gone to Trader Joe's, you see that there's a bunch of people, they have the boxes, they're like putting it into the shelves. That takes a ton of labor. Okay, so Costco, they save all that labor by just putting the pallets like kind of directly on the sales floor. Okay, they also don't need a lot of warehouse space because like a Trader Joe's is such a small retail space that they have these large places where they aggregate all their inventory. And that's like a separate real estate investment that they have. And then from that distribution center, they send the goods to all the stores. Costco doesn't really do that. The stuff just comes directly to the store. Okay. So they're saving on that. So the fact that they can go from buying the inventory from their vendors directly to the floor, and they sell the merchandise in less than a month. Okay, that's kind of the turnaround time. The average time it takes from the time they buy it to the time they sell it is less than a month. And what that means is that usually when they buy the goods, they don't have to pay the vendor for 30 days. Okay, so what they're doing is that they're buying for $1. They're not giving the cash yet. They're selling for $2 before they even have to pay the vendor. So they basically don't have to finance that inventory purchase. They don't pay. They're selling it before they have to pay for it. Okay, so this is a negative cash cycle. This is a huge advantage. They don't have to go to a bank and be like, "Hey, I need to borrow $100 million to buy inventory." They're essentially selling the thing before they have to pay for it. Okay, and this is like really, really rare and very valuable because you don't have to worry about having what we call working capital. Okay, it's kind of like the airlines where the customer pays up front and you can use that cash to pay for the plane and the whatever the salaries and stuff. Okay, so usually retailers don't have this. They have to figure out a way to finance the inventory. Okay, Walmart is another one that does this. They do it through a much more like sleazy or like cutthroat way. Okay, they just tell their vendors typically if they require 30 days, Walmart's like, we're not going to pay you for 60 days. Screw you guys. You have to figure out how to pay your workers and stuff. Okay, so they're more cutthroat with their vendors. Costco does not have to be because they sell the goods so fast. Okay, so so yeah, I think you'll see this a little better when we talk about the different transactions for buying and selling inventory. But yeah, Costco is like, they have a ton of advantages. They have a ton of customer loyalty. They have this retail model that's so capital efficient, and they just have a culture too. Like honestly, the culture that they built from the beginning. They just they pay their employees really well, and whatever they're doing is working. Okay, it's like it's a business that's very hard to beat and to disrupt. Okay, all right. Any questions on this? Comments? Clarifications? No? Okay. Okay, so I think I've mentioned some of this before, but let's just be clear. The income statement, there's going to be a couple of new things that happen. Okay, we were using service revenue before in the homeworks and stuff. Now we're going to use sales revenue. Okay, so this is the new type of revenue that we're going to be dealing with the merchandising business because it's not service revenue, right? It's revenue coming from the sale of goods. So we're going to call that sales revenue. Okay, and this is what we get from the selling high, right? Because the basic business model is buy low, sell high, right? So this is the sell high part of it. As I said, cost of goods sold. What type of account is this? Expense account. Okay, it's a type of expense. This is going to represent the buy low part of it, of this business model of buy low, sell high. These two, the sales revenue and the cost of goods sold, are going to be matched together. And so inventory is an asset, and then when the time that it's actually sold, it could be months later, right? If you're like Tiffany's and you're selling jewelry, you may have some piece of jewelry in inventory for months. Okay, and during that time, it's held on the balance sheet as an inventory asset. But as soon as someone buys it, it's going to be taken out of inventory and expensed as cost of goods sold and matched with whatever you sold it for, whatever that revenue was. Okay, does that make sense? This idea of the matching principle, you want to match what you bought the inventory for what you sold it for in the same period. Okay, make sense? Okay. The gross profit is just sell high minus buy low. It's like what you sold it for minus what you bought it for. But again, for the banana, that doesn't capture everything, right? If we bought the banana for $1 and sold it for $5, that doesn't necessarily mean our business is doing well. Because if we only did that one time, we still have our, if we sold one banana and made $4, yeah, our gross profit was like, the gross profit percent was great. We like made 5x what we bought it for. But we had to pay rent, we have to pay our salaries, we have to pay all the other stuff. So if I only have $4 actual dollars of profit, I didn't actually do well, right? So it's not just the profit margin that matters, it's the turnover. The combination of those two things will determine the profitability of this type of business. Okay? And then on the balance sheet, the big change is that we have this new asset called inventory. Okay? So again, when the merchandise business buys inventory from their vendor, it's going to be stored on the balance sheet as this inventory asset. Okay, inventory is an asset account. Okay, and again, when that inventory is sold, we're going to convert inventory to cost of goods sold. Okay, so I'm just kind of rehashing. I think I've touched on this stuff already. So, but now, hopefully, you now have a second shot at understanding what's going on. So if you don't understand, or if I haven't been clear on anything, ask now. Nobody? Yeah, Chris.
So the inventory is sold, like, sales, cost of goods sold.
Yeah, because again, the sell high, this sales revenue, and this cost of goods sold are going to be dated the same time because it's one transaction, but it's going to be two journal entries. And you're going to see, like, when you generate sales revenue, you're going to receive cash from your customer, which is a debit. We're going to credit sales revenue. And then the second part of this, debit cost of goods sold, credit inventory, right? Because inventory is an asset. When it goes down, it gets credited. And cost of goods sold is an expense, so that gets debited. So they're going to be just two separate journal entries. Okay, but we're going to see that. Don't worry if you didn't catch that. That's like further down the line here. Okay. Okay, so let's look at some stuff here. Oh man, that didn't work. Okay. Okay, so this is Target. Let's see. Let's just look at the balance sheet. You can see here inventory. See, it's their largest current asset. They have $12 billion in inventory. So this includes all the goods that they have sitting on the shelves of the stores, plus their distribution centers. It's all here. And this is how much they've paid for it. Okay, this is their cost basis. The buy low part of this, right? That's what the value, the dollar amount is representing that. Okay, so now let's see. So if you see here, this is their net sales. This is the sales revenue, 106 billion. And this is the value of what they paid for those items that they sold. Okay, so what is approximately the gross profit? Just as a dollar amount. 30 billion, exactly, right? 106 minus 76 is 30. So it's 30 billion. Plus they have this is like everything else. This is like their utilities. This is like paying all the employees. This is their corporate kind of expenses. This is all the other expenses of running the business. Is this 21 billion? So you can see that by far the cost of the items is that's like the largest expense, right? Those items that they're selling, that's like main cost for them, right? And then afterwards, like of that 30, they're paying all the other expenses, which leaves, have depreciation. So of that 30, 20 goes here, or 22, and then around 2.5. So their operating income is what's left over from that. And then they have interest, and their net income is here. They have some other income tax, all this kind of stuff. So they're making, so in summary, they're selling $106 billion worth of stuff, and their profit at the end is $4 billion. Okay, so this is when they say like a low margin business, right? They're of every dollar that they're selling, they're only keeping around 5 as profit. Between the rest of it is the cost of their inventory, all their expenses to run the business, and then the shareholders are left with $5. Okay, so retailing is a very, very like it's a very difficult business because it's pretty low margin. Okay, so every dollar that you can save on buying inventory. So this is why if you work at Costco and you're a buyer, meaning the person who's like going out to the vendors and negotiating the deals to buy the inventory, that's like a super important job, right? Because if you can buy lower, you're going to make a higher profit, and each dollar that you save is going to and especially if you're buying millions of units, it's going to translate to a lot. And of course, what you sell the items for, like Costco, they have the model where they're just going to mark it up 15%. So actually the buying for them is the most important part of their business. They really need to buy well because they're going to fix the profit percentage. Okay. So the buyers at Costco probably make a lot, I bet they're like very, very it's very hard to get that job probably. But they're like maybe some of the most important employees at the whole company. Okay. That's why, they're smart too. You go to Costco, I don't know if you guys who shops there, but the clothing and like the stuff they got is like pretty good. So whoever's like doing the shopping there, I think they know what the people want. So they're pretty smart about it. I was reading that, or I was listening to a podcast. Nike, they are like want to have this image of like we're like better than Costco. So I don't know, I think this has happened at some point because they're really desperate to sell shoes. They just had a bunch of extra inventory, but like it's hard. Like Nike will not sell into Costco, right? They want to keep their brand a little more elite than that. Okay, so but there was a moment where they were like under pressure. They really needed to generate some sales because they probably had a bunch of inventory building up. And Costco buyer, hit them up and we're like probably bid them super low, and we're able to get those Nike shoes for a really good price. Okay, so again, that's like it's a negotiation, right? When you are a merchandiser, your profit is based on buying low and selling high. So depending on what levers you can pull, you're going to try to either buy for lower or sell for higher. Okay. Okay, so this is Target, right? So this is like a retailer, and they're just kind of like everyday essentials. Let's look at Capri Holdings. This is for Versace. This is like a luxury brand retailer. Okay, so let's see what theirs looks like. Okay, so you can see here, the revenue is much lower. Okay, it's 4 billion. Their cost of goods sold is 1.6. So as a percentage, who's making more? Per dollar of sales, who's making more money? So we saw with Target, they're making 30 billion out of 106. Okay, so maybe let's just do some math here. So gross profit and this is sales revenue. So they had like 30 billion out of 106. So their gross profit percentage is 28%. Okay, so this is Target, and we'll just call this Versace, but it's like some holding company that owns a bunch of brands, luxury brands. So what was it? So their gross profit is, and see, they did something a little nice. Okay, they actually did a subtotal here. So a lot of retailers will do that. See, you can see Target, they just kind of threw everything together. They didn't give you that like extra line to show you that subtotal. We just calculated in our heads, right? But these guys are a little nicer, making their financial statement a little more readable, right? That's what as we know, this is a report. It's meant to convey information to the reader. Okay, so they're doing something a little nicer. They're explicitly stating what the gross profit is at 2.8. 2.8, and their revenue was 4.4. So if I just do the same math, okay, you can see that the gross margin for Versace, or the Capri Holding, as we call it, is much higher. Okay, it's because they're selling luxury goods, so they're selling less of it, but their gross margin is much more. Okay, so these are two different kind of business models. And if we looked at a grocery store, it's going to be even lower than Target. Okay, grocery stores it's like the most cutthroat retail business there is. It's like so low margin. Every single dollar matters. Theft for these companies, that can like eat a huge amount of their profit because it's such a low profit margin business. That's why a lot of these, like Target and a lot of these stores, close in places where there's a bunch of theft, because it will kill their whole business. Okay, so yeah, the news won't tell you that. It'll just be like, oh, the Target is like screwing the neighborhood over. But it's, in the end, it's a very competitive business, and they just can't afford to take those losses because they'll just be running at a loss. Okay. Because remember, this is just the gross profit. This is not including all the other expenses, right? The employees, the rent, the utilities. We saw that with Target, it was like another, it was like 20 billion, 22 billion, right? So this 30 of gross profit is actually much less after you substitute or subtract all that. Okay. And let's see, yeah. So in the end, these guys are actually making a loss, though their gross margin is high. They have a bunch of selling expenses. They got to probably spend a bunch on advertising and all kinds of crap. So in the end, they're actually, see, operating expenses is more than their gross profit. So this company is operating at a loss. Okay, so this is unsustainable. Their net loss is 1.1 billion, and it looks like they had a good year a couple years ago, or a better year, but looks like this company is struggling. Okay, any questions on this? Make sense? The two different business models of having a higher gross profit but maybe a lower turnover versus lower margin, higher turnover. It's gonna, they're kind of different business models, and it also depends on what you're selling. You cannot, the stuff that Target sells, you can't really mark it up a lot. Okay. Okay, so this is the basic operating cycle. Okay, so each of these we're going to cover kind of separately, because they each are accounted for a little differently. So this first one is the purchase of inventory. Okay, so we're going to kind of start with that, but I'll just walk through what happens. So you buy the inventory. This is going to be held on the balance sheet as an asset. The second step is you sell the inventory. So this is where it goes cost of goods sold. So there's one journal entry for revenue and a second one for cost of goods sold. So that inventory gets expensed as cost of goods sold. If you sold it on account, you have some account receivable, and then eventually you get that cash, and then you're going to buy more inventory. And this cycle is just going to repeat. Okay? So this is kind of the operating cycle. So we're going to take this one at a time. We'll start with this purchase of inventory. This invoice, I guess, is kind of it's general because when you are buying inventory, you're going to receive an invoice. When you're selling inventory, you're going to give an invoice. Okay, the parties are just going to be kind of swapped around. So in an invoice, you're going to have who the seller is. So you can see, I guess this is from our supplier, our vendor. So we are the buyer in this case. This is our company, right? You're going to have some date of the invoice. This is going to be important because the inventory or this purchase is going to have some time period where you got to pay this off. And it's going to start from the date of the invoice. So the date of the invoice is important, okay? It's also going to be relevant for your accounting books because this is going to be kind of like a transaction, and it's going to be dated as of the time of this invoice. This is what we call credit terms. This is going to specify within what period of time are you allowed to pay this off before the vendor is going to be pissed off. Okay, and we're going to see some other things where they want you to. Is the vendor wanting you to take your time to pay or to pay you sooner? What's better for them? Sooner, right? Because they got expenses to pay. They got to pay their workers. They got to pay their utilities. They got to pay for whatever. Like if they're a manufacturer, they got to buy all the raw materials. So they want that cash sooner. So they will oftentimes offer the customer some incentive to pay fast. Okay, so we're going to talk about how that is kind of spelled out in a second, but it will be on the invoice somewhere. You're going to have kind of what the items are, their item SKU number, right? There's some identifying, probably some identifier. It's usually some kind of inventory, like a number or like some way to identify what they are, a description of what they are, how many, so the quantity, per unit cost, and the total, which is just the quantity times the unit cost, right? So 100 times 5 is 500, 50 times 10 is 500, okay? And then you have your subtotal and the total due, okay? So pretty straightforward. I think we've all seen this. We've all ordered stuff. We all kind of have seen an invoice, yes, to some extent or another. I think the only kind of new thing is these credit terms, okay? So the way this works, so this is a typical credit term, the short form of it, okay? So it says, let me zoom in here, 3-15, comma, N30. So what does this mean? It means that the vendor is like, if you pay me within 15 days, I will give you a 3% discount. Okay, so in the case of this $1,050 invoice, you could multiply this by what to get a 3% discount? Okay, yeah, to get 3% is this times 3%, or you could do this times 0.97, and that's going to give you how much you have to pay, right? Agree? Okay. If it takes longer than 15 days, then the N stands for just the net amount, like the total, within 30 days. Okay? So you either can pay me 97% of it if you pay me within 15 days. So I'm going to give you a little discount, or I'll give you a total of 30 days, but then you got to pay me from day 16 through 30, you got to pay me the full amount. And after 30 days, you're late, and maybe I'm going to have to do something about that. Okay? So there's different permutations of this. Okay? So think about what these mean. Okay? These are different terms that you may see. Okay? And I'll give you a hint. The vendor does not have to offer you a discount. They can choose to do that if they want the money sooner, right? Because they're giving you an incentive to do that. So make sure you're clear on what is being offered here. Okay, so take a second, look at these, think about it, and then we'll discuss what they are. Okay, 1-10 comma, N45. Who has some idea about that? Let's ask, what about Edgar? You here? Yeah. What do you think? Mm-hmm. So, what does the one represent? Okay, what about Teresa? You want to know? Aaron? Let's- Uh, what about Jimmy's not here? Okay, what about Zoe? What do you think? Okay, 10 days, I agree, but what does the one represent? Anyone? Yeah. So you'll get a 1% discount if you pay within 10 days. And then what about the rest of it? Yeah, the N45. What does that mean? Okay. 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 So let's slow down for a second. Okay, so let's just finish off. So the 110 N45, this is like by itself, okay? This you could see this as one credit term that's offered. Okay, so it means 1% discount if you pay within 10 days of the invoice. If you don't pay within 10 days, you have a total of 45 days to pay, but you have to pay the full amount. Make sense? Okay, what about this? What about Kaylee? What do you think? N60. What is that? It's okay. Scott, what do you think? Exactly. There's no discount. You just have 60 days to pay off the full amount. Okay, so as I said, the vendor does not have to offer a discount. They can just specify you got to pay me the full amount and just however many days that they're going to give you. Yeah, exactly. Yes. Yeah. You have 10 days to get that 1%. Yeah. Okay, so now let's apply the same pattern to the next one. The only thing with this is this, what does this EOM stand for? Anyone know that? Yeah, you got it. What is that? End of month. Exactly. Okay, so 220, meaning 2% discount. You have 20 days to avail yourself of that discount. Else, you have to pay the full amount by the end of the month. Okay, so the invoice date is going to matter because you're going to have to see, okay, from the time of the purchase or the sale, when is the cash coming in, and you have to see if it's within this discount period, if a discount was offered. Okay, and that's going to affect how you do your accounting. So you need to be familiar with what these terms are, okay, because it's gonna affect how you're going to do your journal entries.
What is the last day they can still get the discount? For example, if they paid on first, They have 10 days. Is it on 10th or 11th?
Yeah, it's on you have until the end of that day, so the 10th day.
Until the end of 10th.
So the 11th, you will have to pay the full amount. Okay, any questions on this? Yeah. Okay. Yes. Well, from day 11 through 45. So if you paid it on the 23rd day, you have to pay the full amount. But you have until 45 days. That's like the last day you can do it. But you only have from days 1 through 10 to get the discount. Yeah. Yeah, I mean, at some point the vendor will just stop supplying you, and if it's enough of a account receivable for them, they'll take you to court or whatever. Yeah. Okay, any other questions? Yeah, Adam. What do you mean? No, you'll get you'll get the full, yeah. So your incentive is like to pay on the 20th day, you know? Yeah. No. Yeah, so you can see here that the terms here are net 30. So this one there's no discount. They're just like you got 30 days to pay. Yeah, it'll be written here 110 net 30 or whatever. The credit terms will be like stated somewhere. Okay, any other questions? No? Okay. Okay, so the shipping also matters, and there's some terminology that we should just talk about. FOB, okay? This is like a shipping term. It stands for free on board. Okay, it basically it's gonna be where ownership is exchanged. It's so FOB Oakland Port. Okay, if you had some shipping, if you bought something from Vietnam, okay, and the terms of the sale is that it's FOB Oakland Port. Okay, that means the person that you're buying it from, it's their responsibility and their liability to bring the goods from their location to Oakland Port. Okay, that is where you will then take ownership, and from then on, you got to transport it. You got to pay for the insurance. You got to insure against the loss, right? So it's a really important term. It's where the responsibility is exchanged, okay, and the cost, right? So if you were to buy goods from this Vietnamese vendor, and they're like, hey, it's $5, okay, per unit. Is it $5 FOB Oakland Port? Is it $5 at whatever, like Ho Chi Minh City port? I don't know if that's like a port city, but it's the only city in Vietnam I can think of off the top of my head. So it's going to make a difference because the shipping cost is probably going to be something of substance, you know? So it's relevant. It's an important term to consider because the transportation is often, you know, since we live in a world where there's a lot of long distance trade, this term is going to matter. Okay, so in these two examples, FOB shipping point, if you're buying it from the seller's location, you have to pay for the shipping to get it to your location. You have to pay for the cost of the shipping, the insurance. If something happens to it, it's like on you. Okay, you're taking liability for it at this point. If it's FOB destination, meaning the exchange happens at your location, then the seller is going to pay for the shipping. They're going to pay for the insurance. They're going to insure against loss. So that's going to be like a significant advantage. So even though you can buy an item for $5 per unit, they're not the same depending on, you know, if this was $5 per unit. Which one would you rather have? Which one is better? Left or right? Yeah, this one, right? Because it's this price and you're getting it delivered to your location. This might be $5 per unit, but then you got to pay plus $1 for shipping, you know? So it's actually $6, apples to apples. Okay? The discount, okay, we talked about this, the credit terms. If you did have to pay for freight, this discount does not apply to that because whoever's providing you freight is probably like FedEx or some other logistics company. They're not involved in this, 220 net 45. That's like between you and the vendor. They just want to get paid whatever their freight is. So if you're paying for freight, that early payment discount is not going to apply to that cost. It's only going to apply to what you're paying to the vendor. Okay. The key thing to consider here. So we're going to see freight both in the case that we're buying inventory, and when we are selling, we may pay for freight to sell the thing. The treatment of it is totally different. Okay. When you are paying for freight and you're buying the inventory, it's going to be capitalized. It's going to be accounted for as an asset. When you are paying freight to ship it to your customer, that's going to be expensed right away. Okay, so this is an example of you got to be very crystal clear whether you are the buyer of the inventory or you are the seller, because you may have a inventory or like an invoice from FedEx, but you're going to account for it differently, whether that was for inventory you purchased versus inventory you're selling. Okay, so I just want to state that explicitly because this is something that is easily confusable, because you're going to see you paid for freight for this particular transaction. Your next question should be, well, did I buy the inventory? Did I sell it? Because there's going to be two different journal entries depending on the answer to that. Okay. Okay, so let's just go through some basic purchase transactions. This is when, again, you are buying inventory from your vendor. Okay, so it's just, if we go back here, it's this transaction here. Okay, that's what we're dealing with here, where you are talking to your vendor and you're buying inventory, and it's going to be put into this inventory asset. Okay, so this is the transaction that we're talking about. So, very simple. You have an asset, debit, inventory, and in this case, we're paying cash. Okay, so your asset, no change. You have one asset going up and one asset going down. Okay, pretty straightforward, yes? We agree? Okay. We can also have this case where we're buying with an account payable. Okay, so we have an asset going up, but we have liability also going up, so our accounting equation is still kind of okay. So everyone okay with this? This is just the purchase of an asset either with cash or with a account payable. So we've seen this before. Okay, so there's going to be now just a little bit of extra flavor thrown in here because of this purchase discount. So let's talk about that. So if we're buying, and it's really only relevant for this situation, okay? This is the only time where this credit term situation applies, because if we're paying for cash, there is no purchase discount. We're closing out the transaction in one shot. We're just giving the vendor cash. Okay, so there is no it's a moot point. This credit term is not relevant for a cash purchase of inventory. It's only relevant if we're have an account payable. Is everyone clear on that? Does that make sense? Yeah? Okay. So you're gonna basically so I guess we're now kind of clearing this out. So we've made this account payable, and now we're gonna pay it off, and we're gonna basically get a discount. Okay, so we're assuming that we get a 3% discount. Okay, so when we initially bought the inventory, we accounted for the full value of it, $25,000. But we're not actually paying $25,000. Look, we're getting a little discount. This is the amount of cash that we're actually transacting. So our inventory asset is not worth $25,000. It's only worth $24,250 because we bought it. That's how much we actually bought it for. Okay, so we have to reduce the inventory by that discount amount. So you can see here, this $750 It's going as a credit here. And so now my ending inventory balance is correctly lined up with how much cash I paid. Okay, so on the front end, we have this inventory, right? This is where it was created, but it's unclear whether we're going to actually pay 25,000 because we have that discount available. Okay, so in this case, we say that yes, we paid within the period of time to get the discount. We're getting a 3% discount. And so we're going to have to clear this account payable. We no longer owe the full amount. So we want to make sure that this is zero. We calculate how much cash we're paying, which is this times 97%. Okay. That's how we get to this cash amount. And then to make the journal entry balance, we need more credit, and it's going to go to inventory. And it's because initially this inventory was overstated. It's not actually worth 25,000. It's worth 24,250. So now, again, the inventory value is correctly aligned with how much we actually paid for the inventory, which is what we want, right? We want that inventory to reflect the value of that inventory. Okay, any questions on this? No? Okay, so the other part of this is returns. Okay, so oftentimes you will return, maybe they sent you the wrong items or they're defective, or there's going to be instances where your business needs to return inventory. Okay, so it's pretty straightforward. You're just going to reverse the entry that you did to buy the inventory by whatever by the return amount is. So you can see here, we initially bought 25,000. We're just going to swap the accounts. Okay, or I guess this is how it's supposed to be. But if you look up here, we have inventory debit, accounts payable credit. We're just going to swap those. We're going to do accounts payable debit, inventory credit. You can see now that these are correctly lined up with how much they're supposed to be. Okay, any question on this? This is, I think, pretty straightforward. Returns. Now, there's another thing called an allowance. Okay, the difference between a return and an allowance is whether you keep the items. So a return is when you actually physically give the items back. An allowance is like, I don't know if this has ever happened to you, where you order something on Amazon and it's like the wrong thing. And you call in and you're like, hey, you sent me the wrong thing. They're just like, keep that item, we'll send you the new one. That's an allowance. Okay, so you're not going to pay for that thing that you have in inventory. That the cost to you is zero, right? If they allow you to keep it. So if you were to sell it, it would just be pure profit, right? So your inventory is not gonna reflect that cost because you actually didn't pay for it. Okay, so the journal entry is the exact same. Okay, because even if they allow you to keep it, you're still gonna pay them less, right? You're only gonna pay them 24,000. Even if you said, hey, this $1,000 item, I don't want it anymore. They're like, okay, don't worry about it. Just keep it. We won't charge you for it. That's essentially what is happening here. Yeah.
So the item that Amazon said keep it is not even in the books.
Yes, because you're not paying for it. It has no cost to you. So if you did sell it, right, because it's physically there, you would only just record a revenue. There would be no cost of goods sold because it didn't cost you anything. So that's like, if your vendor just gave you stuff for free, it would be pure profit, right? You'd have no expenses, right? So in this case of the allowance, that could happen. Yeah. Okay. Okay, and then finally freight costs, and then we're going to do some practice problems. Okay, so look, your freight cost is going to depend on the terms, right? So if it's FOB your place that you want it, there's no freight, right? The seller is going to pay for the freight to get it to your location. If it's FOB, their location, or some other midway point, you will have to pay for freight. Okay, so again, this is specific to purchase transactions where you're buying inventory. You're going to capitalize that cost. You're going to hold it as inventory. It's going to be part of your all-in cost of how much you paid for your inventory. So you can see here that actually not only do we have to pay, like capitalize or keep in inventory the $25,000 that we paid, but also this $500 freight cost. And then when we sell these items, all of this will become cost of goods sold, including the freight. But only when we sell those items. Okay? Okay, so let's do practice problem. So this is going to be one of the tabs, so you guys can download the sheet. And it's the first tab, 5-3. And it's just, you're given 4 purchase transactions here. Okay, so now you can see that one of them has a credit term. So you're gonna have to figure out, based on the dates of these transactions, did you get the discount? Did you not? If you did get the discount, how do you account for that? So try and see if you can apply what we just did to this problem. Okay, so this first one, what accounts are involved? We just talked about this new account that we're going to be using for merchandise business called inventory. It's an asset. Okay, so I'm going to get this. I'm getting inventory. That's what this whole transaction is. I'm receiving these goods that I'm going to be selling at some future time. So this asset is going to increase. So when an asset increases, is that a debit or a credit? Debit. Okay, good. So 20,250 is going to be our debit to inventory. And our credit is going to also be 20,250. Is it cash? No. This would be coherent, but we see here that we're buying it with credit. Okay, so this is going to be our liability count called accounts payable. Okay, and we're also offered these credit terms. So if we had 15 days, what is the last day we could pay this off? What is the transaction date within which we'll get the discount? Exactly. So if we pay off this accounts payable before February 17th, then we're going to get the discount. Do we agree with that? Yes? Okay. So I can already see on the 14th we're going to pay it off. So we are going to get the discount. Okay. If this had been the 18th, right, we would not get the discount. Okay. So, but let's just do this in order. Okay. So next, we're paying $90 for freight. And we're going to assume it's with cash because it doesn't say on account or we borrowed or anything. So we're going to assume it's with cash. So I already know that there's going to be a credit to cash, right? Our order of kind of operations when we're looking at a transaction is figuring out what accounts are involved. That should be the first thing that you're thinking about. This transaction occurred. What accounts are affected by it? I still see a lot of you just like not even going through that first step. I don't know, how you guys are thinking about it, but I would recommend you read the transaction and think about what accounts are touched by this. What's going up, what's going down. Okay? Maybe there's 2 things going up. In the case of this, inventory went up and accounts payable went up. Okay? So in this case, cash is going to go down because I'm spending cash. So I know it's going to be a credit to cash. Now the question is, the obvious kind of first order is like, okay, freight expense. But I mentioned this in the lecture, and in case you missed it, when you're buying inventory, when you're paying for freight, you want your inventory asset to be fully representing the full cost of it. Okay, so if we have our T account here, so far we have 20,250. That's how much we're paying our vendor. But again, we want the all-in. How much did it cost for us to obtain this inventory, have it in our warehouse, sitting there? It's got to include this freight. Okay, so this is actually going to be inventory. Okay. All right, everyone clear on this? Okay, good. Okay, so on the 9th, we returned 5,000 of the inventory. Okay, so they didn't use the word inventory. So you have to, again, you turn on your brain a little bit, understand the intent of this transaction. What is economically happening is that you have some inventory and now you're just returning it because it was defective. So you no longer, that value is gone from your inventory. You know that asset is going to get depleted by that value, 5,000. You're also not going to owe your vendor because you're returning those items, right? So you're not going to pay for them. Okay, so it's going to basically be the reverse of this. Okay, so you're going to, so let's just be clear what's going on here. Okay, so now when I post this, so 5,000. Okay, so look, this credit to inventory is now here. Accounts payable gets a debit 5,000. Okay, so now this makes sense, right? This now the balance in accounts payable is properly reflecting how much I actually owe to this vendor. And my inventory balance is now properly reflecting my cost. How much have I paid? I mean, I haven't paid for it yet, okay? But at least it's the theoretical cost. Okay, so now we're going to actually pay the cash, right? We're going to see how much this inventory is actually worth when we fully transact and close the loop on it, right? So that's what this last transaction is doing. Okay, so we're going to get the discount. So right now, this is the gross amount. So if I'm getting 315 net 30, we determined that we will get the discount. So what do I multiply this by to get how much I'm actually going to pay? You can do times 1 minus the discount, right? It's the same as 0.97. We're all good with decimals and that. Okay, so that's how much cash I'm going to pay. Okay, so I know I'm going to credit cash. If I were you, I would start with that. It's the most like common sense, straightforward thing to calculate. How much cash am I actually going to pay? Okay, now all the other journal entry parts will fall into place. I know this needs to go to 0. I will no longer owe this vendor any money. So I know that I have to debit accounts payable by 15,250. Do we agree? Right? I'll know after I pay them off, I should have no accounts payable. Do we agree with that? Okay. So I'm going to debit. But this is not balanced, right? My debits don't equal my credits. I can't, this is an invalid journal entry as it is. So I need some third account. Do I need more debit or do I need more credit? I need more credit, right? My debits exceed my credits and I need 457 more credit. So where should I, what account is also affected by this? This is going to go to 0. I like that. This is how much cash I'm paying. because I'm getting that discount. What about this? Is this the true value of my inventory? No, because I only paid this much plus the 90, right? It should technically be $90 plus this. This is actual cash out the door to buy this inventory. It should be this much, but right now it's this. So it's overstated. So if I did this, let's just double check this minus this. Wow, amazing. Our system works. Okay, so as long as I credit my inventory, it now is properly reflecting the actual cost of that inventory. It's now properly reflected in my balance sheet. Is everyone good with that? Clear? Yes? Okay, yeah, Edgar.
For February, I guess doesn't work and this then you only
Where does it say this? Before the 17th. Wait, so sorry, I'm missing what you're saying.
said one drugstore paid about you less and this
Right, right.
so you were paying less than that calculated 8,500.
Okay, so what about this do you disagree with? Just to get to the less the return. This is the account payable less the return because we returned 5,000. So do we agree that this is the balance of accounts payable? Okay, so the discount is $457. What did you get for the discount? That's a big discount. If you owe 15,000 and you're getting a $6,000 discount, that's like a 50% discount. So I disagree with your calculation.
I got it. Fine. The total 20,250
You're only getting the discount on this outstanding account payable, which is 15,250, and it's only going to be 3%. So what is 3% of 15,250? Yeah, because that's all you owe, right? I mean, this is the starting point of calculating the discount. You're getting a discount on what you owe them. Is everyone good with that?
Why don't you discount from the you bought?
Because I returned some of that. So the total amount I owe them after the returns is this 15,250. Okay, so that is the starting point of calculating the discount. The 20,250 is irrelevant because I no longer, that's not actually how much I purchased from them because I returned 5,000 of it. Okay, so everyone good with the calculation? Again, this times 0.03 is this 457. That's where that came from. That's the discount. That's where this is coming from. Okay, yeah, Marguerite.
So this is a rounded number. Do we care about the?
Yeah, it'll tell you in the homework what to round it to. Yeah,
It does.
it does. Okay. Yeah, I don't know. It will say round to the nearest dollar. It will tell you how to round it in the homework. Okay, everyone good with this? This is, again, we're just talking about purchase transactions here. Okay, we're going to then switch gears to sales transactions. That's when you are taking this inventory and you're selling it to your customer. Okay, it's going to be a different set of journal entries. So again, whenever you're doing the homeworks or whatever, thinking about this chapter, you have to think about, am I the buyer of inventory or am I the seller of inventory? And depending on that answer, you have to switch kind of modes, okay? Because there's different accounting treatments for things depending on that answer. Okay, so we now have just covered when we are buyers of inventory. Okay? Okay, so the selling of inventory, let's just at least cover, I think we have a couple of minutes, just high level. there are going to be 2 journal entries for every single sales transaction. Okay, so this is the big difference between if you're buying inventory versus selling inventory. Okay, selling is going to require that you do 2 different things. Okay, number 1, account for the revenue. Okay, so that's going to be 1 journal entry. And then the second one is going to be accounting for the buy low part of it. Okay, so look, this is our 1 single sales transaction. Okay, we're selling some amount of items. Here is 1 journal entry where this is how much our customer is paying us. It's either going to be account receivable or cash, depending on what happened in the transaction, it will tell you. So you're going to debit that, and you're going to credit sales revenue. Okay, this is how much your customer has paid you for, let's say, 10 items. Okay, you paid some amount for those 10 items at some point in time in the past. Okay, that's what this is going to be representing. This is your cost for the same items. So you're going to take them out of inventory. So it's going to reduce your inventory balance, and you're going to expense it as cost of goods sold. Okay, so if we look at the T accounts, we had some amount of inventory. We're selling some of it, right? Maybe this is like 100 units. We're selling 10 or whatever it is, however many. So you have to, now we know this is now 90 units at this cost. Okay. We have the revenue. So all this stuff is, it's all linked. It's here. This is here. And then we assumed accounts receivable. So that's all the T accounts from here. Okay. You can also offer discounts, right? Just like your vendor offered you a discount, you can offer your customer a discount. Okay, so you're going to see these same nomenclature, it's the same formatting, but now you are offering it to your customer rather than you being offered it from your vendor. Okay, so it will look the same, but now you're like on the other side of the trade. Okay, so your assumption is that you will not take the discount when you record the sale. Okay, so when you first record the revenue, you'll assume that they're going to pay you the full amount. And you're only going to record the discount if they pay you, if they actually avail themselves of it. Okay, so you can see here, you're going to use this sales discount. It's a contra account. Okay, so you initially recorded the sale of 5,000. I guess we're starting with this, but you obviously you're not going to get 5,000. They're only going to give you 4,900. So that 5,000 of revenue is like not. It's like you can't show all of that in your income statement because you didn't actually get that much. So you have this contra account called sales discount. Okay, so this is another. I mean, this is like the first taste of like it's I guess the second taste. The first difference between you being the buyer versus seller is that when you're selling, there's 2 journal entries. The second is when the discount is taken by your customer, you're going to have to use this contra account called sales discount. Okay, so you can see here that these 2 are related, right? This credit balance and this debit balance are going to offset. So your net revenue, and you saw that in those financial statements we looked at, they just reported it said net revenue, right? Because they're accounting for returns, discounts, all that stuff, and they're only reporting this kind of net revenue because that's actually the real revenue, right? Yeah.
Where this leaves in the assets or
Where does what lead?
the contra account sales discount?
This is a contra revenue account, so it's going to be in the income statement. Yeah, so it's going to be part of your equity. Yeah. Okay, so your account receivable needs to go to 0. So again, this is the case where your customer took the discount. Okay, you offered them a discount. They're going to avail themselves of it and not give you the full amount that the sale was for. Okay, so again, they're going to get 2% discount. So 5,000 times 2% is equal to $100. That's where this is coming from. Okay, so you're going to get this much cash. The account receivable has to go to 0 because they no longer owe you any money. And to make the journal entry balance, you need more debit. It's going to be $100 to this contra account. And so when you then group all this together, it's going to balance. It's going to actually show how much revenue you collected. It doesn't matter what that beginning point in time is, because let's say, like, just to be like totally, if you wanted to scam someone and you weren't accounting for it like this, you could be like, hey, I'll sell it to you for $10,000 and give you a 90% discount, right? So your income statement, if you didn't do this, you could show I had $10,000 of revenue, even though if the person took the discount, you're only going to get 1,000, you know? So the net revenue is actually the important number. It doesn't matter what that initial undiscounted amount was. Yeah, you have a question? Yeah, I mean that's why the companies report the net revenue. Yeah, because like the financial statement reader, like the accounting rules are such that you can't just puff up the number like that. Yeah. Okay, don't forget about the midterm. Don't forget to do the DSM by Wednesday before class.